Have you ever wondered if there's a better way to think about financial independence? One that's focused less about chasing a magic number and more about building sustainable income? Well, today I'm thrilled to bring on a fascinating conversation with our guest, Steve Selengut, author of the book Retirement Money Secrets, and a true expert in rethinking how we approach retirement and investing. In today's episode, Steve shares his philosophy on income independence, the mindset shift to prioritize generating steady income over simply accumulating wealth. We'll also dive into the power of closed-end funds and how they can be a game changer on your journey to financial independence. And be sure to stick around to the end because this conversation is packed with insights for anyone looking to build a strong financial foundation. Whether you're planning to retire in the next 5 years or just getting started on your journey, let's dive in. Steve, you wrote the book Retirement Money Secrets. Could you tell me what inspired you first off to write this book and share some insights on and what makes you want to share your insights on income independence?
Okay. Well, the book I was selling. You know, I was I'm 79, so I was 78. I had managed other people's money for 44 years in a very unique way. My focus was the income that they generated in their portfolios. I wanted them to live this lifestyle that I lived. I wanted them to be able to go travel wherever they wanted to do, just like I do. And it's not a difficult thing to do. It's just a matter of changing your mindset from focus on the market value of your assets to the income that they're producing for you. I mean, twice in my career, I've gotten to the point where I could sort of, say, I don't have to do this anymore. I'm making more money from my investment portfolio than I am working and go off and do what I wanted to do. It turned out to be still working, but you get the idea. So that's what's in the book. It's the how to do that. It's the how to switch that mindset so that it doesn't matter if you have a portfolio that's growing every month. What is important is that you have a portfolio that's generating a growing stream of income every quarter. And that's what the book explains. And I needed to do that. I needed to do that because I was leaving the business. I knew it was time. I mean, how much longer am I going to be able to run $110 million of other people's money without starting maybe to make mistakes? And I had already, for the past 5 or 6 years, maybe even more, I was training a person in my broker's operation to take over, and she was actually managing maybe 25-30% of the portfolio, mostly the smaller portfolios. So I had somebody that could do it for me. So the time was right, the ground was set. My wife and I still had a few things on our bucket list that we had to do, and I decided to bite the bullet, so to speak, and stop doing it. And I wrote the book to document all the ways people could do it. And as I was writing the book, my ghostwriter, who happened to be in her late 50s, early 60s, had all the questions that a person going into retirement would have. One who had never managed a penny of her money herself. So all the questions that you could possibly think of jumped into the Crane's heads, and they spoke and they asked me as we were writing the book. All the questions really came from her because she needed to know the very same things. So the conversation idea of it was perfect. And we came up with this book, and she told me, you've got to become a coach with this, because book is a perfect lead in. People are going to have a lot of questions, and they're going to like to talk to you about it. So I said, but I'm supposed to be retiring. She said, oh, it won't be so busy. Well, she was wrong. That was the only thing she was wrong about. It got very busy.
I was going to say, how busy has it been?
It's been busy. I've met more people and coached more people in this 13 or 14 months since I, quote, retired than I managed money for in my entire career. Like 130, 140 people I've touched already. So it's been exciting.
You said that you wanted to teach this because this is something that you did for yourself. So could you tell me how your own financial journey shaped the principles that you teach in this book?
Um, okay. Okay. We're going back in history now, before you were
Please.
born. Um, when I was a young person, um, I had a lot of jobs. My dad encouraged me to do that. He was a real estate developer in a what was then pretty much a resort type community in North Jersey. Nobody knows that New Jersey has lakes and mountains because they only see the turnpike and the parkway. But west of that, northwest of that, there's a whole area called Sussex County up there, and there's a big lake called Lake Opakong, and it's a resort community. And he bought a whole area of property on the southern end of the lake and started building there. And he built thousands of homes over the years. But he built in a different way. He was you know what vertical integration is in
Yeah.
economics? Yeah, okay,
Hmm.
that's what he was. I mean, he owned the lumber yard that the contractors shopped at. He owned the land. He financed the people to buy the homes. He built them summer homes, but on enough property that they could be expanded. And eventually, as the community grew and grew, he rebuilt those homes. He had rental properties in there, so he was getting rents. He had streams of income coming in. He had an insurance person in his organization that he was getting that done. The auto and the home, not the life and health, but the auto and the home and stuff like that. But literally 4 or 5 different streams of income. So if there was a bad year for property, and this doesn't happen in that neck of the woods so much, but occasionally he'd be in a position where he wasn't getting enough cash flow from sales or from building, but he still had the income, the interest coming in on the mortgages. He still had the lumberyard. He still had the insurance. So something was always bringing him income. And he taught us, that if you want to have a lifestyle like your mother wants to enjoy, you gotta have income. You can't spend, and it got to the point, like on the cover of the book, where it says you can't spend, basically it says you can't spend market value. You gotta have income if you want to do what you want to do. So that's where I learned that from. So, um, so when I got to be 25, um, and I didn't go to an Ivy League school like my brother did. I went to a really a good college wrestling team school in a small college in Gettysburg called Gettysburg. And it didn't cost nearly as much money as Brown University, so to speak.
Yes.
So when I was 25, picture a table in a restaurant where we were going to celebrate my birthday, my wife and I, and my mother and my father. And out from behind, he pulled out from his back. He had this envelope, this no envelope, and he cleared the table a little bit. He just dumped these stock certificates out there. This is
Okay.
1970. This is 1970, when people did still get stock certificates. Seriously, like General Electric and General Motors and you name it. IBM was actually one of them. Shell Oil. Just, and it was a large sum of money for those days. You get a high 5-figure portfolio back in 1970. That was a lot of money.
Hmm.
So he said, okay, here it is. Here's all that money that you put away from working and what I didn't spend on college. It's now yours. Don't lose it. Kiddo, don't lose it. So I started learning about investing. I was out of college. I had taken the courses. I knew about a lot of stuff, but I didn't really know about volatility. I didn't really know about dividend paying stocks versus others and things like that. So I learned that mainly through the broker that I put all the stuff with. And she and I would spend a day looking at the charts of various companies. And I determined my big eureka moment was, with Shell or with GE or with any of them, there are dozens and dozens of times throughout the year where you could sell it at a profit and later on buy it back again. So we made it a point, and we went to find, and all the companies paid dividends, and we sort of set up rules. They got to pay dividends. They got to be in a New York Stock Exchange. They got to be B+ or better rated by S&P. Back in the day, there was an S&P guide that rated all the securities, and you got it monthly. Your broker would get it. So we did all that and wound up with a list of, say, 150, 200 stocks that sort of fit our quality requirements. And then I started trading. And I had a 10% target. And that was after commissions, because we were in a commission environment in those days too.
Mhm.
And I never held on for more than 10%. I'd sell for less. If we were in a market where there were a lot of things that were down, and I could sell something for 7% and buy something else that was down in its lower range, I would do that, kind of just switching them out all the time. Within 7 years or so, I was making more money than I was making in New York by about 5 times in my commuting. So that's the point when I got started and say, hey, I can do this. I don't know of anybody else who's doing it based on the type of income that I'm making with this. And I was talking to friends all the time, of course. I said, I know a couple of guys that'll let me manage their money. I'm getting started. So that's when it happened. It was just like that. And started off with a couple friends. Never started with family like a lot of people do. My father said, hell no, I'm not going to the stock market.
I think that's for the best. That's what I did too.
So it just grew and grew and grew. And even when I moved from New Jersey, it was very face-to-face contact when I was up there. The internet, there was no internet when I got started, so everything was kind of more personal then. And then we moved down here to South Carolina, and it continued to grow. And then it became, with the internet and everything, it became national. So, and even international. When I left, I had coast-to-coast clients. My broker was paying those fees to places like Texas and Illinois, all those, the fees that you have to pay, they were paying all those, and not liking it a whole lot because we didn't have more than 2 clients in Texas, but it was just big, and really spread out all over, a couple overseas. So that's how I got to where I am. And income has always been the fuel. It's been I never got phone calls during corrections. I didn't get phone calls in the dot-com bubble because I was never in the NASDAQ, and I never owned a mutual fund. So, hey, no problem. I mean, it was fine. The high quality, the dividend paying high quality companies actually went up when the dot-com bubble hit. The New York Stock Exchange was rising while the NASDAQ was going down into the toilet. So that's the type of program I had. It was always quality based. You never lost sleep. Your clients never lost sleep, which is the most important thing. And that's how I got there.
So you told me that you originally started out in trading stocks. At what point did you start moving into the closed-end funds? And before actually we get there, would you mind, Steve, explaining what a closed-end fund is to our listener? Because most people don't know what that means.
I know they don't. Closed-end funds are actually the oldest form of fund. They were out there before mutual funds, and hundreds of years, well, not hundreds, but more than 100 years before ETFs. And the biggest difference they have is that they are a trust vehicle. They're a pass-through trust. And if you know anything, if your listeners know anything, that's a kind of trust where the money comes. It's like what you'd make for your children and their children, and where the money comes in, but the trust doesn't pay taxes on it because they're giving all the way to your kids, and they're paying the taxes on it. So So 95% of the money that comes in goes to the owners of the company, much unlike stocks, where most of the money goes to the CEO. Maybe, I don't know, but anyway, it seems like. So that's the big distinction. And so the purpose of these things can't be to grow market value. They got to give away 95% of their income. So they can't grow like an Amazon or a Microsoft or something like that. What they want to grow is they want to grow the income that they generate, and they do a pretty good job of that. So that's the big distinction. So closed-end fund trades like a stock on the exchange. Another great thing, and that's true of the other funds too, but here you can own municipal bonds, you can own corporate bonds, mortgages, real estate, and you can trade it day to day in the stock exchange. You don't have to go get quotes on what this bond is selling for at the trading desk and the markups and markdowns and all the other stuff you had to put up with. You can sell them instantly, just like a stock. So a lot of different advantages, and a lot higher income for a lot of different reasons. So that's what closed-end funds are.
I use closed-end funds with my retired clients in order to generate income. But why do you feel that, as the proliferation of more financial knowledge has come out and more people are getting smarter when it comes to investing due to the advent of the internet, why do you think that everyone's now just shifting from mutual funds to ETFs, but no one's talking about the closed-end funds, the grandfather of them all?
Because they're boring. They don't go up in value. And the whole financial world runs on AUM. Okay. Now that there's no commissions. In the old days, commissions were scary because there may be 0.1% of advisors would churn or take advantage of clients and just buy and sell and buy and sell and buy and sell. But it doesn't take more than one. The honest guys don't make the newspapers. So the pressure was on, and I always was a fee-based advisor. I was never a commissioned salesman, a commissioned broker. So I think somehow they figured out that I had a lot less pressure and a lot easier because I was getting based on performance. I was getting paid on the market value performance of my portfolios. And they said, we should do that. The difference was that my portfolios went up in market value when interest rates were lower and the market was up, because of the type of securities I used. But if you'll look inside the model, the model portfolios of today and things like that, they are selling. There's no income being generated by any of these things. I look at when my coaching clients, I look at their portfolios, and 3% would be the high end of the range of what these portfolios are generating. And even scarier sometimes is a diversification in them. When they're not models, they're typically not very well diversified. Yeah. So it's both of those things are going on. But no, people don't hear about them because they're not sexy. They're not designed to go up in market value, and that doesn't generate the AUM for the home office. They want to see, your job is to grow the amount under management, and that's why we're paying you.
That's between you and I, that's the reason that I have my own independent firm, is because I couldn't handle it anymore. I couldn't handle being told what to do.
Yeah, I know the guy, the one person that I use, some of the coaching clients don't want to do it themselves. And they asked me for a referral, and there's only one guy that I know of that is purely a closed-end fund guy and an income-focused guy. So maybe you're the second one now.
We can talk about that later. So, Steve, most of our listeners, they have no idea what a closed-end fund is because it's not something that's very talked about. Can someone just go on to their brokerage account, maybe at Schwab, Fidelity, Vanguard, and just buy a closed-end fund?
Oh, sure. And they can go to a place called CEF Connect, Closed-End Fund Connect. And there's a couple other CEF places that I don't use, but CEF Connect I do because they're not trying to sell anything really, even though it's sponsored by Nuveen and it's mostly an educational site. But you can use the screening capabilities in there. You can screen them by type. You can screen them by whether they're equity, fixed income, tax exempt income. You can screen them in any category. I usually do it by yield, and then I look at each one. I make sure it's got more than 50 securities inside. I make sure that it's been in business for 5 years or more. I make sure of a number of things before I'll consider it for my universes. But I have 3 universes that I look at. I have a tax exempt, taxable income, and equities. And would you believe that the tax exempts right now are paying over 6%? And I have a list of 50 of them that are paying that much tax free. And the income ones are paying 10.5%, and the equities are paying about 9.7. So it's because interest rates, even though I guess maybe in your age group, well, how do you feel about 5% interest rate? Is that high interest or low?
For me, it's high because from what I remember, I mean, from the time I started knowing about this stuff would be 2000s, and from there it was
There you go.
basically zero until now. So for us,
Good.
for me it's high, but I also know my history, and I know that my history would say that it's actually still quite low, but we
Yeah.
only remember our recent past,
I
not
know.
our past.
Exactly. So So to me, before the Great Recession, interest rates were almost never as low as 5%. Almost never. I mean, I remember buying New York, New Jersey Port Authority bonds, tax exempt bonds with a 12% coupon. Interest rates have been very high in this country over the past, and most people's first mortgage experience was in the 6 or 7% range, or maybe even higher. So today's interest rates are a whole nother animal. It's hard for me to get used to the idea, but with closed-end funds, the lower interest rates go, the higher the prices go. So you can then, even people who the most experienced, and some of the other writers about closed-end funds only emphasize one stream of income. They are still set it and forget it type of people. It's great. I mean, closed-end funds are great. You can just sit there and watch this, average 8 to 10% higher now than usual, coming in every month and smile and love it and live a good life. But I use a second stream of income. And that second stream of income is profit taking. And I've always used that. This year alone, my profits were equal to about 45 to 50% of my total income from distributions. So I added another 5 or 6% to my income, my spendable income, because of taking profits. So, so there's so much more. Go ahead.
How do you differentiate between taking profits and timing the market? For our listeners who might be hearing that and being like, well, it sounds like Steve is explaining that he's timing the market, but I know that that's not what you're doing, because I do the same thing. But how would you differentiate that for our listeners?
Timing the market is like if somebody said to you today, I'm not putting anything in the market because it's at an all-time high and I know it's going down. So I'm keeping my money on the sidelines until it crashes. That would be timing the market. Okay. Or if somebody said after that happened, the crash happened, that it's down now, it's at a historical low, so I'm going to throw all my money at the stock market so that I can watch it go back up again. That would, again, be timing the market. When you're an income investor, you're looking at the yields of things, and the market cycle is certainly important. So what I do, for example, right now, when I'm buying equities, if I'm putting a new equity closed-end fund into my portfolio right now, because I keep my equities at about 35%, and not of my market value, but of my working capital, which is a whole nother subject, really. It's actually the total cost basis of everything. So I want to keep it at 35% because that's as much risk as a person my age group should really be taking.
Yeah.
And even though with closed-end funds paying 9%, and the way I they're not as risky as individual equities. It's still the principle. So what I do, because I know they're at their highest rate right now, my normal entry position into a security is probably about, I never in my life have spent 10 grand at one time on a security of any kind. So my normal size in equity, let's say when the market is just not near its peak, would be something like $6,000, $7,000, $8,000 initial position. When you're at a peak of the market like this, it would always be at a lower level. You start off, let's say, okay, I'm going to start at $5,000 because the market is so high. So one of two things is going to happen. Okay? It's going to go up. I'm going to take profit. It's going to go down, and if it goes down 10%, I'm going to add to my position. If it goes down after that, if it goes down another 10%, I'm going to add to my position again because I vetted these positions. These are your IBMs of the world, that type of thing, and put into a fund of IBMs type qualities that there's never been a correction that hasn't been replaced by a rally, and vice versa. There's never been a rally that hasn't disappeared. So while it's in its up stage, I buy less. I add to it if it goes down. I sell it if it goes up, and I do it again and again and again. It keeps going up, I keep selling. It keeps going down, I keep adding. But I'm only adding to securities that have a history of dividend paying, a history of profitability, and a history of it's just household names. I mean, when I used to run portfolios in common stocks, there rarely was a security whose name my clients weren't familiar with, because I never went near the new issues. I never went near IPOs and things like that. I was always very boring in my approach.
And that's sometimes hard, especially in today's modern age, to tell people like we're going to invest boring, and boring is good because people want the hot, they want the sex, they want to be able to tell their friends at the golf course, I'm invested in these crazy things, and they
Yeah,
want to be able to tell the story. But sometimes you're able to tell a good story, you're sacrificing that great story for the results that you actually want.
yeah. I mean, the great stories, like you said, that I own the video. Wow, or you can find 1,000 more companies that have been, quote, NVIDIAs that don't exist anymore. Not because they were bought out, but because they went to zero. Then you can find NVIDIAs that are still operating. The Microsoft, the Amazon. Very few. There are very few
I
of
mean,
those.
how many companies have remained on the S&P 500 for the past I don't know 80 something years? I think it's two or
Yeah.
three.
Yeah, well, they started changing, even the Dow, you know. In the beginning, when I was investing, no NASDAQ company was ever on the Dow. I don't know. I think Microsoft might have been the first one. I don't know. But it was for a long time before any company that wasn't, there was no new issues ever got there or anything like that. The S&P and all of them have gotten a little less fussy now, and they change out pretty quickly, like Sears coming off the, you know what I mean? And they're
So
in competition with one another instead of just saying a set of facts about the market. They want the Dow to operate or to grow as quickly as the NASDAQ or the S&P. So there's a little bit of competition going on there too.
So what I would definitely recommend, Steve, is that our listeners read the book, because what I fear is that they just heard that conversation but didn't understand the context around being able to fix it. So I'd like to move us on to a different point that anyone could be able to hear this and understand without having to read the book. So your book emphasizes income independence. And here at the FI guys, we are an offshoot of the financial independence retire early crowd, the FIRE crowd.
Oh, are you?
Yeah, but we've lost the retire early, because I don't believe in retiring. I believe in finding income independence, financial independence, so you can do what you want. But how does your concept align or even differ from the traditional financial independence retire early philosophy?
I've never been in that movement myself, but I've always and I'm not interested at all in retirement,
Mhm.
but I know how it is to put people into a position where they can retire if they choose to. And I do that again, like what we were talking about, the emphasis on generating the constant, consistent, and growing streams of income to get them there. Not by, I think a little bit of the FIRE movement has a little bit of speculation in it.
Mhm.
Things, they're looking for a hot spot. They're looking for something that they think is going to be popular and it's going to make them money. I'm not sure they pull the trigger soon enough. I think I think it's a market value focused um, uh, financial independence as opposed to income independence.
Uh-huh.
If you have a big enough number, if your 7-figure becomes, an 8-figure, that's financial independence. It's not necessarily income independence though. you know, I had a I was working with a client a month or so ago whose net invested capital was over $10 million, but his income from it was, you know, only a couple 100,000. Which, you know, I'm I'm saying one way or another, you got to get at least 100,000 per million.
Mhm.
If it's just income like you can do it now, fine. But if it's not, then the capital gains take over for it and make it. And in this guy's case, everything was buy and hold and been sitting in the same funds or the same securities forever. It was a lot of money. And yeah, he could have said, I'm done working and start the normal retirement process of you sell some stuff and you spend it. You sell some stuff, you spend it because he wasn't going to run out of money.
Mhm.
But income independence is when that nut keeps growing and you're just living off the income. That's where I want to get people to be. So their kids, I mean, when so their they can pay their grandkids education and not have to sell any capital to do it.
Mhm.
You know, they can take care of a child's, for their kids, their grandchildren's an illness, a trip, things like that. They can do for people without dipping into principal. That's when you're income independent. That's the difference. That's where I'm going with
Yeah.
people.
So earlier on, when we were talking, you talked a lot about changing people's mindsets to be able to do this. What are some of the key habits or mindset shifts that you believe are critical for individuals in the pursuit of income independence?
I think the key is that the one critical one is to um, change your focus when you open your statement online, or if you actually still get statements in envelopes. Instead of looking at that big number, the bottom line number, you go to the point in there where it says how much income you received this month.
Mhm.
When you start looking at that monthly income instead of the bottom line market value, that's when you've arrived at the point where income independence is really your target. I keep track of three main numbers.
Mhm.
Some of them I add together, and that makes it more numbers. But the three main numbers I look at when I get my statement every month: my base income. Base income means the income you get just from interest and dividends, distributions from the securities. I want that number to grow every quarter. Every month's going to be different because in the CEF world, some pay monthly, some pay quarterly,
Mhm.
and varies. So the base income has to grow every month. The working capital is the total cost of what you're invested in, how much money you put into all your securities plus any cash in your portfolio. That has to grow every quarter.
Mhm.
The only and let's talk a little bit. Base income grows if you add money to it, dividends, interest, and capital gains. That's the only way it can grow. The only way it can go down is if you spend it or if you take capital losses.
Mhm.
So it stays the same, basically, unless you take losses or take money out. So that's the second one I look at. The third one I look at, and I don't know which brokerage firm you use, but most firms probably give you this thing. But Fidelity gives you this, and it's on page 4 of your statement for each individual, and it gives you your projected 12-month income. Month by month, how much income you're going to receive from your securities over the next 12 months. And I want to see that grow every quarter. And if those three numbers, that's all I have to look at. As long as they're going up, I know that I'm managing the portfolio properly to my needs. And I add up the two numbers. I didn't mention capital gains because you can't be assured. There's no guarantee you're going to have any of those. Most years you will, but I look at my total income, but I don't look for the total. I don't look at that as the thing that has to grow. It's the base income, the working capital, and projected income. Those three things, and then when the bride says, "Hey, I want to go to Mexico this winter," you say, "Okay, no problem," and you can do that.
Now, you make it seem very simple, but what mistakes do you see that most often happens among people trying to achieve this, and how can they avoid them?
I think it's probably with the the younger you are and the more things that come up that you want to do or the purchases you still have to make, like the new car, the vacation, stuff like that. When you're just getting started, you probably have a lot of those things that are going to take you backwards a little bit.
Mhm.
But as you get older and you're pretty much have a budget that doesn't really change very much from year to year, and you're and you have been able to accumulate money from your job and stuff, and your amount becomes bigger and the income function gets bigger, it becomes that much easier. Like I used to tell people, as long as I can reinvest at least 30% of the income I'm making for you, I'll make your income grow because I'll be able to put that much back to work. So I guess the key thing is spending too large a percentage of your investment income will keep you from growing it. So that's one thing they make. They think it's going to go on without any downturns, any problems, any glitches, and it won't. There's going to be situations. No matter how safely you try to invest things, there are going to, something's going to happen
Mhm.
occasionally. You know, so so you have to prepare for that. Yeah. So you don't spend it all. You have to put some of it to work. And the earlier you can start taking profits, the easier that becomes because that builds the basic capital that's producing the income.
So would you say
So
before we even get to the investing, before we even get to trying to become like implementing what you have inside the book, before we get there, we need to make sure that we have a good foundation. We need to know how much money we're spending. What are our expense tracking? Are we paying? Do we have a budget? Because if we don't have that
yes.
foundation, you're going to
Oh
wreck it
yeah.
eventually.
It's very important to be there, to be at that point, to that stage where you can take X amount of money and put it away for your future, over and above that 401k that you're adding to at work. That's important too. And there are ways that you can prepare better with that if you think about your choices in there during high highs and low lows.
Mhm.
High highs, you want to move some of that stock market stuff down to some other thing, and then and vice versa. But that's another story. But the mistakes they make are not understanding that you can't go out and pick try to pick big winners or new issues that aren't paying you anything and hope that you're going to succeed to grow your retirement nut. You got to do that more conservatively. You have to look for quality. You have to minimize your risk. You got to identify features that mean quality in an investment. We talked earlier, the age, how long has it been in business? What kind of a product mix does it have? Does it pay dividends? Things like that. And then the overall diversification of what's going on. You got to get that in control and make sure you don't have too much money in any one thing. You got to make sure I don't have in my portfolio. I don't even have 2% of my portfolio, not even close in any one position. But we learned in school 5% was good diversification. If you're anywhere near 5%, you're crazy in any one position in the stock market, particularly even in the bond market. I don't do that. I stay way below that, and I coach people to stay as I like diversification, as you know, is the big risk minimizer and everything. It's like a defensive weapon. I turn it into an offensive weapon. I own everything. I have that many things, that many different closed-end funds that every sector, every country, every type of investment is represented. Not with huge numbers, but it's represented. So I've got full diversification. Income generation we talked about, and they have to learn not to fall in love with securities. They have to take profits. They have to put a target on that profit. They have to say, I'm never going to let, no reasonable profit is ever going to go unrealized. And what is reasonable is a function of where we are in the cycle. If everything in a portfolio is up, a reasonable profit could be 5%, could be 10%. But if the market's not all that strong, a reasonable profit could be $15. Because when you take a profit, let's say you have a $5,000 position, you take a profit, it might just be a $10 or $100 profit, but that's $5,000 of capital now that you can reinvest in something that's down 15 or 20% to increase your income. So those are the ways that you go about doing it. But quality diversification, income, profit taking, understanding where you are in the market cycle. Am I up? Is the market cycle up? So I don't want to put as much money in a stock as I normally would, but I still want to buy it. It's in the interest rates right now, in the interest rate cycle, we're really still not high. Those prices aren't as high as they were when interest rates were zero. So there are really a lot of bargains in that area of the world right now.
So let me ask you a question. Here at the FI guys, most of our audience are young adults, millennials, Gen Y, 20 to 40 years old. Now, your book, Retirement Money Secrets, I don't feel that the average young person would ever pick this book up. This book is most likely geared at someone who's looking to retire. But how can younger individuals adapt the strategies you talk about in your book, which may have been designed with retirees in mind, and adapt them to their unique situations and their elongated timelines?
It's easier for them. The earlier they start putting money away in an income-focused environment, the easier that retirement will be. They'll never even have to worry about it. I did that. I started in my first investments. As soon as I got started, I had 30% in income. I started buying tax-free municipals. Right, my first municipal was a Fort Pierce, Florida, 4% coupon bond. I held it for the whole 30 years. Today I would never buy an individual bond. Back there, I didn't know I had a choice. Mm-hmm. So yeah, the earlier you start, do this for your children. Do this in that college fund. My God, you'll get to the point where you can pay the tuition out of the income. Can you imagine paying that Harvard $40,000 a year or more? Probably more, right?
Yeah, probably more. Definitely.
My granddaughters was that much, and that was at Wofford. So, out of income. That's where you have to start. Start now. When you get that first bonus, put it all away. Don't buy that convertible yet. Buy that next year. first year, get a base in there that's generating income for you. Yeah, I think there's a lot of features. I agree with you that it was designed for the 50 plus and retired community for sure. I mean, that's what we were talking about. That's what we were on vacation talking about, this type of investing, and that's where it's at. But I didn't start in my 50s.
Mhm.
I started when I was 25, 26 investing, and I made sure then I had income investments.
How much time do you think it takes, Steve, for someone after reading your book to implement it? And then after they've implemented the system, they know it. How much time are they dedicating now to keeping the system working towards, buying new, bringing more funds into their universe, buying, selling, all of that?
It can be time consuming when you first get started. I mean, for me, it takes me an hour after the market closes every night to get all my orders ready, and that's on a pretty substantial portfolio. All my ready, they're actually ready and placed. Not for trading over, after the market closes, but for the next day. So 9:30 every morning, I hear my phone going tick 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 as the notifications for Fidelity come in of my orders going off. So it's all done, and I'm out of the office by 5:10 at the latest. So an hour and 10 minutes to run a portfolio my size with 240 positions, because you don't have to look at every one every day.
Mhm.
You push a button and it puts it in order by profits. So I take my top 3 profits and I'm done with that screen. And then you put it in order by what went up today. And each day I only look at the ones that went up today to determine if there's any lots inside that I want to take, trimming profits that I talk about in the book. On the buy side, again, I buy the positions. I, you know, I own them all, so I just buy what I've sold within the last week or two. I just buy them again, because the first thing you look at when you buy is the yield, and I know they're all yielding an average between 9 and 10%, so I don't have to worry about that. I know that. If it's in equity, I say, okay, it's at or near an all-time high. I'm going to buy less than I normally would, so I buy less than I normally would. If it's income security, I buy my normal position. And I do that, and then I go into my list and I put it in the opposite direction. I say, which ones are down the most, or their cost, they're the smallest positions and I put them in order, and I go through which one of them is down the most, and I find one that's down 8 or 9%, I'll add to it. If I don't find any, I'll buy another new position. So it doesn't take a whole lot of time once you get there. Once you get to the point where you got a large enough portfolio that it's generating the income you need, and the only time you really have to look buy new things is beginning of the month, end of the month. That's when all dividends come in, and you want to reinvest them selectively. You don't want to drip and do stuff like that. And that's pretty much the only work you have to do. You look at your profits, look for profits, add to positions, and that's it.
So here are the five guys. One thing that I found, my background is in human psychology. And what I've found as a financial advisor for years is that the perfect plan means nothing if you're not willing to execute on that plan. So what I found is when I try teaching people things like you've taught, and I've tried teaching them, most people, when they're young, they're working 20s, 30s, 40 years old, they don't have the time, they don't have the desire, they don't have the bandwidth to deal with those things. So do you think it might be possible for both of these two things to be true, your system and my system, of while you're younger, if you don't have the time, you don't have the desire, you don't have the willingness to do this, set it and forget it in a growth and pursue financial independence. Once that number is big enough, and once you say, okay, I can retire from my work, now I can dedicate time to learning this system. Is there a world where both of these systems are true simultaneous?
Absolutely. I think so. But I think what it should be is a professional can do that without it being a set it and forget it. You can be an advisor for a person in the approach that I'm talking about, and he doesn't have to be there to do it. You can do it for him, and you don't have to do it fanatically like I would do, every day. But you could certainly do it if you know the market hits a new all-time high. You know there's going to be a profit in there that you should be taking, and you go and do it. If we've had a trend upward and you've been adding to his account all the time, you know there are going to be lots in some of those positions that are at profits, and you can find them. So, yeah, I mean, I'd love to see a case where we have enough financial advisors out there who know how to generate income like I do, where a person could go, hey, I read this book. I want to do that. Will you do that for me? I want, and I won't, we could even, I wrote an article called Vetting an Investment Advisor.
Mhm.
And I just laid out a few things like just make sure he's making more in profits than you're paying him in fees.
That's pretty basic.
Okay, that's one thing he can do that.
Mhm.
He's going to tell you at some point in your life that you'll have to spend 4% of your portfolio every year. I think that's a good figure. Well, make sure he's generating at least 4% in income. So he's got to generate at least 4% in income plus enough to cover his fees. Okay, and pretty much if he does that, he almost has to go to these income focused securities to do that. If not, or he's going to buy nothing but dividend stocks. And that's not a bad approach, right? But he's going to stay away from the speculations. He's going to stay away from the model portfolios. He's going to actually, earn it. I think. So I think, yeah, there could be a blend of the approaches. You're going to have to do it. You're going to have the old do-it-yourselfer who's got nothing on his hands but time, and he's going to take. I have people who have become addicts to take profits. They just because they enjoy it and they're growing the capital and the income. But you don't have to do that. You can have an advisor do it for you, and I don't think it's going to take the advisor all that time. I mean, a secretary can go through the accounts and tell you where you've got a trimming profit to take, or can go through every a weekly go through your entire managed portfolio and put them in order and see where there's a profit that has to be taken. When I was managing at Fidelity, it told me from my whole client base what the top winners and losers were. I could put that in order. So it could be John, Mary, Harry, and Frank could each have one of the top winners. And I could go right there and take their profits. So, you have the tools. Your advisor has the tools to do a lot of this without being quite as manic as somebody like me would be.
So, in the interest of time, I'd like to ask you a few closing questions, John. Remember that our average audience member is 25 to 35. If you could leave our audience with one actionable step that they could take and move them closer to income independence, what would that be?
Step for a 25-year-old to a 30-year-old to take. I think we probably covered it already. I think it's that shift, that mentality about how you approach the stock market as instead of being as an opportunity to make an instant winner or a killing and really make you rich overnight. Think of it as something that can make you very, very income secure by the time you need it to be. Because right now you're in your high earning years. You're getting started. You're growing in your firm, and you don't want to worry about this. So find these securities that generate this kind of income, and eventually you'll get like Steve was when he was 34, where he was making more money from the money he had set aside than he was making at work. And he could say, okay, I'm going to turn this job into my own business, or I'm going to do something new. I think that's the clue. Don't go up there trying to hit a home run. Go up there trying to hit some singles, and just hit a lot of singles, and you'll get there faster.
Yeah.
And you'll be in a better position for that.
So,
When
Steve,
the time comes where you need to make a decision.
I agree. You've been so generous with our audience members today. I want to give you the podcast to tell our listeners to learn more about you, your book, where they can come to find you. Podcast is yours, sir.
thanks. I guess the key, I think, for anyone who wants to get into this is to read that book, Retirement Money Secrets, to learn how to get to where you want to go, really, I think. And it's really kind of a history of what I did myself to get out of that job I had in New York City and start my own business. And then when I was able to sell that business to afford to continue my lifestyle while I waited 18 months for the guys that bought me to pay me, like almost 40% is held back. And I had to live on what I was making from my investments to maintain things. So yeah, the book will help you with a lot of that. I have a website called theincomecoach.net where you can learn about the services I provide, and also where you can hear about a community that I have, which it's called the Retirement Money Secrets Income Investing Community. And you can join that, and for really peanuts per month, you can get all the selection universes you'll ever need. So you'll see all 200 plus closed-end funds that I use, that I've vetted the quality and the income and all that with. And we have free Q&A sessions, at least one a month. And there's a lot of other things, other goodies, and it's really a very small investment. I mean, tomorrow you could do it at $25 a month.
Wonderful.
So something to think about. And there's a link to that on the website also.
Perfect. If you provide me the link, Steve, I can put it inside the show notes. So for our audience members, look down below and that'll be there for you guys. Now,
Okay.
Before we close out, Steve, I always have one more question for everyone. The concept that I have been trying to figure out my entire life has been, what is enough? And this is quite a profound question, but what I found is financial independence, income independence varies from person to person to person. So I'd like to ask you, Steve, what is financial independence mean to you? For you, what is enough?
I think I'm at the point now where I'm doing things because more for the fun of it than the money of it. I think that's a target I think people should have. I mean, I like to do things for family when I can. There's no hoops they have to jump through or anything like that. I don't know. You get to the point where when it's not fun, I'm not going to do it anymore. So that's really where you want to be. If we decided that we, like I said, if we decided something was going on overseas, or we wanted to go to a place, we know we could do it if we wanted to, without thinking twice. I think that's my target. I want to stay there in that type of thing. I think that's what you should shoot for.
To each one of our audience members, think about that question for yourself. What is enough? Because there isn't really a right answer or a wrong answer. Everyone's answer is just different. So, Steve, thank you so much for joining us here on the Five Guys podcast, for demonstrating your wisdom and your knowledge thus far. To our audience members, please pick up the book, Retirement Money Secrets. I will have links down below for you guys. And please leave up to a 5-star review, follow the podcast, like and subscribe. And most importantly, please share the podcast with one friend who you want to have income independence as well, because it's so much more fun to go on this journey with a friend than to go alone. Steve, thank you so much.
Thank you, Chris. Great.
This video podcast is sponsored by Monzon Wealth. The content in this podcast is for informational purposes only and should not be considered financial advice. We do not endorse specific products or services. Past performance does not guarantee future results. The opinions expressed are those of the host and guests, not the podcast sponsor.
It is crucial to consult with a qualified financial advisor or professional who can provide advice tailored to your specific needs before making any financial decisions, investments, or taking any other actions. If you are seeking specified help, you can reach out to Chris at monzonwealth.com.